And joining us for a closer look at what's playing itself out in that market scene is Cobus Potgieter from Southern Cross Capital. Cobus, happy Wednesday to you. Thank you for your time today.
Good afternoon, Olatandi. Thanks for having me.
Brilliant. So great buying screens all around, a bit of a stronger rand. We see resources counters really coming through. Let's talk about what markets are dealing with today.
All eyes on the Fed today. Of course, this rally triggered somewhat by the news released by Reuters overnight that some semiconductor manufacturers outside of the US will, in all likelihood, not be subject to the sanctions or the ban on exports to China. So that seems to have triggered, in line with very good AMD guidance, decent growth overnight. A bit of a rally in tech and in the market as a whole. And typically the market takes a wait and see approach on a Fed day. We have the FOMC meeting this evening. However, I think given that these mega caps have sold off so aggressively, the market was sort of looking for a reason to inflate those assets a little bit again. So, sort of a double whammy of positive news in that we are hoping to see two cuts before year end. And we're looking for maybe not the rates announcement itself, but more so the guidance for the rest of the year. Maybe getting some guidance from Powell around whether or not we will see those two cuts. And somehow all of this has overshadowed the negative news out of the Middle East, where Hamas's political leader was allegedly killed in an airstrike over Tehran by the Israeli Defense Forces.
I'll also ask you what we're seeing emerge with those mega caps. Cobus, it's a bit of a confusing story. Were we correcting, what we're seeing with the Magnificent Seven? Then now, of course, we're seeing a bit of a rally. It just looks like a cohesive story is hard to come by with regards to the market reaction around those counters.
Yes. Look, this is a funny bubble relative to something like the dot-com, where with the dot-com there was no earnings. These companies were all loss-making, and we were discounting future earnings and new paradigms and new normals. These companies are making mega profits at the moment. The earnings are very, very real. What the market has started to question is the sustainability of those earnings. Is the AI theme overhyped? We know companies globally are investing heavily into AI, and that is supporting these mega caps. These mega caps are largely either exposed to the actual, sort of selling shovels in the gold rush in terms of supplying semiconductors or GPUs to the AI market, or they are investing into the AI processes themselves in the forms of large language models. So there is all this demand for the product. The profits are incredible. The margins are fat. The question the market is asking is, where does this trend stop? Where does this market normalize? When does the pricing normalize? When do the margins normalize? And that expectation shifts, and that sort of caused the sell-off we've seen in the short term. But in terms of the actual activity, the economic activity around this newish industry, that's not going to stop overnight. The investments is ongoing, the commitments have been made. So, we are going to see this, but I don't think what we've seen here is necessarily a sustained sell-off in those mega caps. It's more of a correction than anything else. But discounting those future earnings has certainly become, less certain from the market's perspective.
Well, that's it. I'd like to take stock of Microsoft and what we saw emerge from there. They did manage to beat earnings expectations there, but I think their cloud business not performing as well as markets anticipated.
Yes, so cloud has been a major driver for Google, Microsoft, and Amazon. And now we've sort of seen cloud disappoint for both Google and Alphabet, which is Google's holding company, and Microsoft. Cloud, I think people misunderstand it, but cloud is essentially this outsourcing of hardware process that we've been seeing. people running processes virtually as opposed to running them physically on local servers. Nobody has that old file server in the office anymore. And then, of course, also actual processing, which is done via cloud. It's not all just pure number crunching. A lot of this is relatively simple stuff, but call it the digitization of a lot of those processes. Um, I don't have the firmest of view in terms of what's going on here, but it does seem that perhaps we're seeing that market start to mature. And then on top of that, we had this crisis last week with a software bug and a lot of sort of punishing a lot of these companies using Microsoft's cloud services because of which has sort of revealed a new vulnerability, and perhaps we're going to see a little bit of a slowdown in that process. But ultimately, again, it is ongoing, and perhaps the rate of growth slows down, but it doesn't mean that growth goes anywhere.
Keen to bring it home now as well, to reflect on Woolies. They've gone on, I think, to guide the markets in a direction I didn't anticipate. Okay, we knew the South African consumer was cash strapped, but what I actually get from just maybe globally here, Cobus, if I look at what happened with luxury counters last week, and we're seeing premium brands like Woolworths also taking a hit, it looks like, consumers have lost their resilience here. It really is tough at times with the high cost of living and the high interest rates.
Yes, but Woolies is suffering from poorer execution than their peers. I mean, there's no getting around that. Most of the pain we're seeing in this update, and it is just an operational update. We must be clear. We're not giving very good guidance. Sorry, a trading statement. In addition to an operational update, they're reporting in about a month, I believe. So we don't have those specifics. But in terms of the guidance, we can see Country Road in Australia is suffering. Australia is going through a severe cost of living crisis. It's funny that they are on sort of far ahead of the rest of the world in terms of the monetary cycle because of that as well, and those consumers are very, very suppressed. So they're seeing both sales and volumes declines in those markets, despite further investments into trading space, right sizing. We saw them get rid of David Jones last year, but that albatross is still hanging around their necks. And then locally, the fashion business has been, it's been hit and miss. And anecdotally, we can all have this conversation. Woolies just isn't as appealing as it used to be. And they've taken on a strategy of not discounting aggressively, almost intentionally reducing volume, but getting the volume they are getting, taking a higher margin on those items. Uh, yes, we'll see how that plays out, but in the short term, it seems that again that business has seen quite a bit of volume decline. And then, of course, the food business just continues to thrive and remains resilient despite your remarks around the South African consumer. That business just beloved and does incredibly well and seems to be able to push this inflation onto their customers period after period after period. So that's sort of the one golden nugget in this in the soup here. But ultimately, I don't think this was that unexpected from the market. There was an initial sell-off today, but now Woolies is actually well back in the black for the day, in line with its peers as the market rallies.
We don't have much time for this question, Cobus. We literally have 20 seconds, but I have to ask you if an opportunity may arise for Woolworths Food to be listed separately at some point.
They push against this idea
Yeah.
very, very hard.
Okay.
And of course, that business would have a much better rating, and it would be a value unlock opportunity. But I mean, two issues there is, the rest of the business would get an awful rating, and management wants to manage a bigger business. So implicitly, they do kick against this, even though they have the mandate to create shareholder value. And the other issue is those businesses are tightly integrated. We know most of the big Woolies food chains are inside Woolies branches, and unscrambling that egg will be very, very tricky. So I suppose something like this could be pursued somewhere down the line, because Woolies Food has grown more independent from the rest of the business over time. We've seen them, lots of independent Woolies Foods going up. I don't know what the volume splits are between those and the ones located inside the clothing stores, but as that phenomena rolls itself out over the years, perhaps there will be an opportunity. to separate those businesses. But for the moment, it seems there's neither the willingness nor, realistically the capacity to take on a project like that.
With that said, I'm keen to get into stock picks. Let's start off by looking at counters that have found favor with industry peers.
It's in the US, and as people might be aware, there's been a huge shift from your mega cap companies into the smaller mid cap value companies. I don't like the fact that people are mentioning value, but there's certainly a shift of funds into the mid to small cap sector. Don't go for value companies in the sector, go for growth companies, because when interest rates are going down, companies which seemingly offer value because of various reasons are probably going to do worse because the income, because it just shows you a slowing market. So go for a growth company in the small cap sector or mid cap sector. One of those is ABM Industrials, listed in New York. And if you think about what they do, think of Bidvest locally. ABM provides services to, whether it be catering or whether it be cleaning your building, that kind of thing, parking lot management, to a huge variety of companies in the US. They've been listed since 1909.
I'm going for Stellantis. It's one of the top 5 biggest motor vehicle manufacturers. They own brands such as Peugeot, Citroën, Fiat, Chrysler, Alfa Romeo, Jeep, Dodge, Ram, even Maserati, although apparently they're considering to chop that one. And they came out with results recently that were below expectations. The share price has taken a big knock, mostly because they've got too much inventory in the US. They are sitting with too many cars that they haven't sold yet. I do expect the second half will be better, that they'll sell a lot of those cars, and they've spent a lot of money, billions of euros, to invest into electrical cars.
I'm going for Roche Holdings. They're a company based in Switzerland. They're a major pharmaceutical company, essentially with 2 divisions, pharmaceuticals and diagnostics. In the pharmaceutical division, they've got a leading position in the oncology segment, very innovative, investing a lot in terms of research and development, trying to stay ahead of the new drug and finding the next drug that's going to, cure some of the diseases that there aren't any cures for.
All right, Cobus, I'm keen to get your thoughts on those very interesting counters today. ABM Industrials, Stellantis, as well as Roche Industrials.
You like putting me on the spot with some very esoteric offshore picks here. I don't cover any of these stocks, so we'll start off on that basis. I'll happily give my opinion, but maybe it's not an expert opinion as in this particular instance. ABM looks like a fascinating counter, very, very similar history to Bidvest. I don't agree that it's a growth stock. It is actually a bit of a value stock, and it's benefited massively from this cyclical rotation. But it is well positioned and still very reasonably priced. So maybe that is a nice value pick. Stellantis, that is the amalgamation of the old Fiat and Peugeot groups. And it has struggled since Jean-Pierre made that call. It's actually sold off quite a bit more. They've announced retrenchment of a portion of their US workforce. That business is a bit distressed, but it is cheap. It is on a PE historical of 3.5. It looks like sort of a nice punt recovery play, but I prefer its holding company. There's a listed holding company called Exor, listed in Amsterdam. That's the family-controlled vehicle, and that's combines the Stellantis exposure with a basket of very attractive assets, amongst them Ferrari, which have done phenomenally well, and that I think is sort of call it a Remgro-esque pick, which is like a quality a blue chip stock that should be in everybody's offshore portfolio. So I prefer Exor, and of course Exor is also sold off a little bit off the wake of this poor Stellantis performance, but it remains a cheaper entry point because of the holding company discount into those assets, even though you won't be getting that pure exposure. Roche, similar to GlaxoSmithKline, very similarly rated. I don't have a particular view on that, but you know, I see Glaxo came with phenomenal numbers this morning, so perhaps that is the more known play from my perspective, but I don't really have a view on Roche in isolation.
Well, that's it. Which counter are you having this afternoon?
I'm going to go local, just to keep it simple. I'll go small, I'll like a Russell 2000 approach, small cap, City Lodge. So City Lodge, you know, it's almost like a property company, but it's a hotel operator, and it has not benefited from this phenomenal performance we've seen in the property stocks and the other hospitality stocks locally. Some of that was, you know, they were almost caught out in terms of the turning of the cycle. They had to recapitalize. They did this quite late. They delayed the maintenance of their hotels, and just as the market was starting to pick up and that bullishness came back, they were busy renovating hotels, which is always awful for footprint. They've gotten their occupancy up to around 61% as of the last set of results, which is already a 4 or a 5% improvement. So that business is still very beaten down in terms of valuation. It hasn't seen those tailwinds that the broader industry has seen. And I believe when we get the results in a couple of months' time, we're going to see a market improvement, given the overall, you know, positive trend in business, you know, business interest and business activity we have seen in South Africa more broadly, and that's typically where they are exposed to that business traveller ultimately. So that's a nice and very cheap illiquid play. If you are looking for an interesting small cap that might give you significant upside once those earnings do recover.
Cobus, a pleasure having you today. Thank you so much for covering today's markets for us. That was your midday markets update with Southern Cross Capital's Cobus Potgieter.